All right, welcome back everyone to the deep dive. And as always, we're taking one single source this time and going in depth.
That's right, extracting the absolute key insights.
Yeah, giving you a shortcut to becoming truly well-informed about some pretty fascinating topics.
Yeah, and so today we're diving into, I think, something that's probably on a lot of people's minds.
No, for sure.
It's how to invest for the long run. What's the best approach?
Especially right now.
Especially right now. Exactly.
Yeah, so much has happened in the markets, like really just in the past few years.
Absolutely.
I mean, I think it's enough to make anyone question, like, is what I'm doing still working?
Yep.
Are my strategies, are they up to date?
Right, right.
So you sent over this book, The Flexible Investing Playbook by Robert Isbitts.
Yeah.
And this one was copyrighted in 2010.
Mm-hmm.
And, I think it's really interesting that you picked this one out, especially now because, lots happened since 2010.
A lot has happened, yeah.
Yeah. So our mission today is to dig into, like, what were Isbitts' main points?
Yeah.
Like, why did he think that the old traditional, like, buy and hold, just kind of the classic ways of investing
Right.
maybe weren't going to cut it anymore?
Mm-hmm.
And what did he suggest as like a potentially better path forward?
Yep, yep. And that's what we're going to get into today.
Yeah, so let's get started. The book kicks off with a really interesting analogy. He compares your like existing investment playbook
Mm-hmm.
to a football player
Oh, yeah.
who gets traded to a new team, so they can't just keep running the same plays. You're going to learn a whole new system.
Right. Adapt or fail.
Exactly. And that's what we're going to try to figure out today, like how to adapt our playbooks.
Yeah.
So he starts off by, really challenging what a lot of us think we know about the stock market.
Hmm.
He argues that those those huge gains that everybody remembers from the 1980s and the 1990s.
These are the good old days, right?
Yeah, like the bull market everyone always talks about.
Yeah.
He's saying that wasn't actually typical. Like
Yeah.
that was an exception. He's saying it was an outlier.
Yeah.
And he uses these charts, these figures, to show how market behavior has changed.
Over time.
Yeah, and he goes way back to the early 1900s.
Right.
So like way, way, way back to illustrate just how much variation there's been in the stock market.
Mm-hmm.
So he looks at these periods like 1900 to 1920,
Yeah.
the 1960s to the 1980s.
That was a crazy time.
Yeah, and then even, 2000 to 2009.
Right up to when he was writing.
Yeah, and what I think he's really trying to do here is show that consistent growth year after year, that's not really the norm.
No, not at all.
Like, it's more common to see ups and downs,
Exactly. I mean, you look at those figures he includes, 1920 to 1940, 1940 to 1960. There were some real rough patches in there.
Yeah, and he uses this phrase, fallen and can't get up,
Mm-hmm.
when he's talking about what are called secular bear markets, which are basically these extended periods, like years long,
Mm-hmm.
where the market is just struggling to gain any kind of like lasting upward momentum.
Right. It's like it gets knocked down and it just can't seem to get back on its feet.
Exactly. And that's so different from like, the boom times that a lot of people remember, from earlier, like the late 20th century.
Absolutely. Especially if you started investing in, say, the late 80s or 90s, you might have this idea that the market just kind of goes up over time.
Right. Like it's a given.
Yep. But Isbitts is saying, hold on, that's not the whole picture.
Right. Exactly.
You got to be ready for those rough stretches too.
Yeah. And, this really ties into what a lot of people are feeling anxious about right now, right?
For sure.
Like there's this lack of confidence.
Big time.
And the book mentions these surveys from back then showing that people were really worried about their retirement savings.
Yeah, like really worried.
Yeah, in fact, the lowest confidence levels they had seen since 1993, and that was for both people still working and people who are already retired.
Yeah, I think that's the part that's really eye-opening.
Right.
It's not just people planning for the future. It's people who are already living it.
Exactly.
And he even points out how much retiree confidence had plummeted. I mean, it went from 41% in 2007 down to only 20% in the survey year. That's a huge drop.
It is. And I think that's a big part of why this whole topic of like finding a new way to approach investing, it just feels so urgent for you right now.
Right, because those old assumptions, they just don't seem to hold up anymore.
Exactly. So the boom years, those might have been the exception, not the rule.
Exactly.
And then on top of that, Isbitts also starts to question the safety of bonds.
Yeah.
Like, bonds are often seen as the safer option.
Right, the more conservative choice.
Yeah, but he brings up the issue of long-term inflation,
Mm,
And he ties this to the growing government debt.
right, which was already a big concern back then.
Exactly. And his point is that if inflation picks up, it can really eat away at the value of those bond returns
Yep.
over time.
Over time, yeah, and you might even end up losing money.
Yeah, even in those investments that are supposed to be safe.
It's scary, right?
It is. So then the question becomes like, okay,
Where do you go?
where do you put your money if the stock market isn't a sure thing?
Right.
And even bonds might not be as safe as you thought.
Mm-hmm.
So he talks about these investment pigs
Oh, yeah, I love that term.
who are just constantly chasing whatever's hot.
Yeah, always jumping on the latest trend, assuming it's going to keep going up.
Exactly, exactly. And he contrasts those folks with, your classic bulls and bears
Right.
who can both, they can find ways to make money whether the market's going up or down.
Exactly. It's about being adaptable, right?
Exactly. And what I found really interesting is that he really likes this idea of being a contrarian investor.
Oh, yeah. Zig when everyone else sags.
Yeah, basically. And he argues that, like, those times when everybody's feeling pessimistic, like, after a big crash like in 2008.
Right, when everyone's running for the hills.
Exactly.
That can actually be the best time to buy.
Yeah, when everyone's freaking out, that's when you should be looking for those good deals.
It's like when there's blood in the streets.
Yeah, yeah. And he even compares it to people's skepticism about the housing market back in 2006.
Oh, right. Right before everything went crazy.
Yeah, so when everyone else is scared, that might actually be the time to jump in.
Bold move, but it can pay off big time.
Yeah. And another thing he points out is that the stock market often acts like a leading indicator.
Right.
So, like, those big drops in the market.
Like the one we saw before the book was written, over 50% drop in the S&P 500.
Yeah.
That was a big one.
Yeah, so those drops might actually be reflecting bad news that hasn't even hit the broader economy yet.
Right, like the market's kind of giving us a warning.
Exactly. And this kind of leads to a bigger point he makes about forecasts. Like, how much should we really rely on these predictions about where the market's going to go?
Mm-hmm.
He brings up how in 2008, the predictions for the S&P 500 were all over the place.
Oh, yeah.
And nobody really got it right.
Yeah, 2008 was a tough one to predict.
Exactly. And his takeaway is basically like, don't bet your entire strategy on trying to guess the future.
Right.
Like, you need to have a plan for when you're wrong.
Yeah.
He even quotes an economist named Stephen Roach who says something like,
Oh, yeah.
the key is not to get the forecast right,
Right.
but to have a strategy for when you get it wrong.
I like that a lot.
Yeah, so it's about being prepared for different possibilities.
Right, rather than trying to be a fortune teller.
Exactly, exactly. And this leads us to, like, the core of the book, which is this flexible investing playbook idea.
Right.
And he stresses that, like, the first and most important thing is defense.
Defense wins championships.
Yeah, like protecting yourself from those big losses.
Yep, avoiding those big hits.
Exactly. And he uses this really interesting analogy here to compare two different investing styles. And he calls them Yogi and Babe.
Oh, I love this one, Yogi and Babe.
Yeah. So Yogi, he's the more cautious investor.
Yeah, just steady Eddie.
Yeah. And he's really focused on those consistent gains.
Yeah.
Not huge gains, but steady gains.
Right. And really importantly, limiting those downside risks.
Yes, exactly. Like, he'd rather get on base consistently than swing for the fences and risk striking out.
Right. Like a baseball player who's more focused on getting on base than hitting home runs.
Exactly.
And
then Babe, he's the more aggressive one.
Yeah, he's going for those home runs.
Yeah, he wants those big wins.
Yeah.
But he's also taking on more risk of, striking out.
Right. Higher risk, higher reward.
Exactly. And the book looks at how their portfolios would have performed during that crazy time in late 2008 and early 2009.
Oh, yeah, right in the thick of it.
Yeah, and Yogi's more defensive style. It actually held up way better when the market was plummeting.
Then Babe's approach.
And Babe's, yeah.
Interesting.
Yeah, so even though Babe's portfolio had a bigger bounce back when the market started to recover, Yogi, he was in a much better position overall.
Makes you think.
Right.
Yeah, because sometimes it's not about making the most when things are good, but losing the least when things are bad.
Exactly.
So, like, protecting what you have can be just as important as trying to grow it.
Absolutely. And this really ties into his idea of these transition cycles in the market. So, like, when the market shifts from a downturn to an upturn,
Right.
he's saying it's really important to be measured in your response.
Not just jump back in with everything all at once.
Yeah, don't just, like, put all your money back in right away.
Exactly. You want to kind of ease back in as you see more signs that the recovery is going to last.
It's like testing the waters.
Right, like dipping your toes in the pool before you jump in the deep end.
Exactly. Yeah. And he even uses the analogy of like easing your car back onto the road after a storm.
Oh, yeah, instead of just flooring it.
Yeah, like you want to be cautious.
Makes sense.
And then to really drive this point home,
Mm-hmm.
he looks at how a balanced portfolio, like a classic 60-40 portfolio,
60% stocks, 40% bonds.
yeah,
Yep.
performed during this rough period, like from 1966 to 1982.
Mm-hmm.
And get this, the Dow Jones Industrial Average actually went down during that time.
Wow.
But that balanced portfolio, it still managed to grow.
That's impressive.
Right.
Yeah, it really shows the power of spreading your investments and not putting all your eggs in one basket.
Exactly. And I think it's a good reminder that you can find opportunities even when the overall market outlook might not seem that great.
Absolutely, and this really goes against some of the conventional wisdom we often hear.
Yeah, like that whole buy and hold thing.
Yeah, buy and hold.
He questions whether that's always the best strategy.
Especially in those longer-term bear markets where things can change really quickly.
Yeah, like what if you buy and then things just keep going down?
Right, then it becomes buy and hope.
Yeah, and he also takes aim at what's called style box investing.
Well, yeah, the Morningstar boxes.
Yeah, and that's where, they categorize mutual funds by the size of the companies they invest in, like small, medium, large.
Right.
And then also by their style, like growth, value, blend.
Yep.
And he's saying, like, it's become this popular way to think about diversification.
Right.
But it might not actually reduce risk as much as people think.
Mm-hmm. He thinks you need a more flexible approach, something that looks beyond those rigid categories.
Yeah, like style boxes are kind of like if you only sorted your clothes by color and size.
Yeah.
But you didn't think about, like, what's appropriate for different weather.
Right, or different occasions.
Yeah, you need to think about the context.
Exactly. One size doesn't fit all.
And then another thing he talks about is rear view mirror investing.
Oh, yeah, that's a classic mistake.
Which is that tendency to buy whatever's been doing well recently.
Right, because we assume it'll just keep going up.
Yeah, but as he puts it, warning, you may be too late.
Yeah, like that hot stock might have already peaked.
Exactly. And the point is, just because something has done well in the past,
Doesn't mean it's going to keep doing well.
and he's saying it's really important to understand why something performed well.
Right.
And whether those reasons are still valid.
Yep.
And then he brings up this idea that you can actually have a bull market, even when the overall market is down.
Yeah, by getting against certain things.
Exactly, like by shorting stocks or bonds.
Right, betting that they'll go down in price.
Yeah, and he uses the example of 2008, where shorting certain types of stocks was actually very profitable.
Really highlights that there are opportunities everywhere, even in a downturn.
Yeah, if you know where to look.
Exactly, and this all leads to a really important point he makes about how the investment landscape today is very different from what it was in the 80s and 90s.
Yeah, those long gone boom times. Yeah, he's basically saying that we need to adapt our strategies to fit the current realities.
Right, we can't just keep doing what worked back then.
And he emphasizes this growing understanding of secular markets.
Oh, yeah.
Which are those long-term trends, like decades long, that can either be, up or down.
Right, and he's saying it's crucial to tailor your investment strategies to these broader cycles.
Exactly. It's not just about reacting to short-term noise.
It's about understanding the bigger picture, the long game.
Exactly. And this also applies to bonds.
Oh, yeah.
Yeah, he says that investing in bonds requires a new way of thinking.
Interesting.
Because that long period of falling interest rates, which had been boosting bond prices, it was pretty much over by the time he was writing this book.
Got it.
And he warns that even in those, seemingly safe, high-quality bonds, you could actually experience some pretty big losses.
If interest rates start to rise again.
If interest rates start to rise.
Yeah, like we saw in the late 70s and early 80s.
Yeah, exactly. And he also points out something I found really interesting.
What's that?
That historically, the level of volatility...
How much prices swing up and down?
Yeah, that tends to be more consistent across different types of assets.
More so than the actual returns they generate.
More so than the returns, yeah.
Makes you think.
Right.
Yeah, because we tend to focus on those potential gains.
Right.
But we often forget about how bumpy the ride can be.
Exactly. And then he brings it all together, saying that those traditional mainstays of investing, like just diversifying your assets, across different categories,
Right.
or relying solely on stocks for growth, or assuming that bond funds are automatically going to reduce risk.
Yeah, like those are the givens.
He's saying, like, they're not enough anymore.
Not in today's world.
Yeah, not on their own.
Right.
And then he gets into some of the ways that investors can actually hurt their own portfolios.
Oh, yeah, the self-inflicted wounds.
Yeah, like letting emotions like greed.
When markets are high and everyone's feeling euphoric,
Yeah.
that can lead to some bad decisions.
Yeah. And then fear when markets are crashing.
Right, that can cause people to sell at the worst possible time.
Exactly. And then he talks about that classic question
Yeah.
of trader versus investor. Like,
Mhm.
should you be actively trading or taking a more long-term approach?
Right.
And he cautions those, less experienced investors
Yeah.
against getting too overconfident with all those fancy trading tools.
Yeah, thinking they can time the market perfectly.
Exactly. And he uses this great investment football analogy.
I remember this one.
Yeah, to illustrate some common mistakes people make.
Like what?
Like taking advice from too many different people.
Oh, yeah, having too many coaches.
Yeah, who aren't even like coordinating their strategies.
Right, so everyone's pulling in different directions.
Exactly. And then also getting frustrated with your advisor when the market takes a dip.
Right, like blaming the coach when the team's losing.
Yeah, and this leads to his discussion of independent financial advisors.
Yeah.
And he suggests that they might be more open to like moving away from those standardized approaches that you might get from a larger firm.
Right, those cookie cutter plans.
Yeah, and instead really customizing strategies for each client.
Tailoring it to their needs and circumstances.
Exactly. And he's a big advocate for having a flexible investment plan
Yeah.
that uses a variety of different strategies to try to generate returns in what he expects to be
A more challenging environment.
a more challenging environment than those boom years we were talking about earlier.
Right, because those days might be over.
Exactly. And he also cautions against getting caught up in that whole like performance comparison game.
Oh, yeah, constantly checking how you're doing compared to everyone else.
Exactly. Yeah, it's like that saying, comparison is the thief of joy.
Right, and it can lead to some really bad investment decisions.
Absolutely. And he makes this interesting point that an investment that might seem like a weak performer in your portfolio
Right, like it's not doing as well as the others.
could actually be playing a really important role.
Like how?
Like maybe it's providing a hedge
Oh.
against losses in other parts of your portfolio.
Right, so it's not always about chasing the highest returns.
Exactly.
Sometimes it's about balance and protection.
Exactly. And then he raises some really important questions about, investment products. Like how do we evaluate them?
Yeah.
And how much do they cost?
Right, because fees can really eat into your return.
Exactly. And he's pretty critical of what he calls mass customized advice, where you might think you're getting personalized recommendations,
Right.
but really you're just being slotted into some preset model.
Like an assembly line of financial planning.
Yeah. And he warns against trying to cut corners
Yeah.
when it comes to managing your money. And he also talks about that fear of the unknown.
Yeah, that can keep people stuck with their traditional brokers.
Even if it's not the best fit.
Right, because it's familiar, even if it's not ideal.
Yeah. And then he challenges this idea that the stock market will always return, like 10% on average.
Yeah, but old chestnut.
Yeah. He calls it more of a myth.
Than a realistic expectation.
Exactly. And then he goes on to explain some more complex investment products.
Like what?
Like 30/30 funds and leveraged ETFs.
Right.
And he kind of highlights their potential downsides and the fact that they can be a lot more complicated
Then they might appear at first glance.
than they might appear, yeah. And he also cautions against, just blindly relying on past performance.
Yeah, because past performance is not necessarily indicative of future results.
Exactly, exactly. And then he talks about this distinction between tactical investing, which is more about those short-term moves.
Right, trying to time the market.
Yeah, and then strategic investing.
Which is more about those long-term goals.
Exactly. So he's saying that those tactical strategies...
They're more like specialized role players.
Yeah, in your overall plan...
And he also points out that trying to time the market consistently
is really, really hard.
Yeah, it's tough to get it right over and over again.
And then he warns against those, like, Me Too investment products.
Oh, yeah, the ones that pop up after a trend has already taken off.
Yeah, like everyone tries to jump on the bandwagon.
Exactly. And he even questions whether those big mutual fund companies are always the best choice.
Yeah, he suggests that sometimes those smaller, more focused firms might be more adaptable.
Yeah, more nimble, able to navigate those changing markets.
Exactly. And I think it's really interesting to hear about his own journey.
Oh, yeah.
Like how he came to recognize the limitations of that traditional way of investing and how he developed his own more flexible approach.
Yeah, what was his big takeaway?
Well, he talks about, being willing to bet against certain investments, like short selling.
Right.
And he even mentions that SEC ban on short selling financial stocks during the 2008 crisis.
Oh, yeah, that was a big deal.
Yeah, and how that limited the ability to use some of these more flexible strategies.
Interesting.
And he really stresses the importance of doing your research, what he calls due diligence when you're choosing investment managers.
Yeah, don't just hand over your money to anyone.
Exactly. And when he talks about the key ingredients for successful asset allocation,
Yeah.
from his perspective,
Mm-hmm.
adaptability is number one.
Got it.
He says, you got to be able to adjust to changing conditions.
Right, because what worked in the past might not work in the future.
Exactly. And he also stresses the need to move beyond those rigid categories.
Like style boxes.
Yeah, like style boxes, and really understand your own personal tolerance for risk.
Yeah, how much volatility can you stomach?
Exactly. And he also provides a helpful overview of how mutual funds are structured and regulated.
Through the ICI, the Investment Company Institute.
Yeah.
Right.
And he also points out those often overlooked tax implications of investing in hedge funds, as well as the fact that they're not as tightly regulated as mutual funds.
Got it.
And he's pretty critical of those target date funds.
The ones that automatically adjust as you get closer to retirement.
Exactly. He argues that they're preset paths. They lack the flexibility to respond to those changing market environments.
Oh, they're kind of on autopilot.
Yeah, and he even challenges that conventional advice to always go for the lowest mutual fund expense ratios.
Interesting.
He argues that the potential cost of poor performance
Yeah.
far outweighs a slightly higher fee.
Right, so it's not just about the cheapest option, it's about the best value.
Exactly. And then having laid out all this critique of those traditional approaches, he finally introduces his 3 core asset allocation strategies.
Oh, yeah, the ones he designed for a more flexible approach.
Exactly. And he calls them hybrid, concentrated equity, and global cycle. And he emphasizes that each one has its own objectives and timeframes.
Right, so let's break those down, starting with hybrid.
Okay, so the hybrid strategy, it's all about generating consistent positive returns while also having a low correlation to the overall stock market.
Over a minimum period of 3 years,
Yeah, so that basically means it's designed to do well.
whether the market's going up or down.
Exactly. And the goals are steady positive returns, relatively low volatility, so, less of those big swings.
Right, smoother ride.
Yeah. And then being less dependent on the general direction of the stock market.
Yep, less tied to those broad market movements.
Exactly. And it also aims for a more predictable range of potential outcomes. He mentions that the typical holding period for most investments in this strategy is 1 to 3 years.
Okay.
But there's also flexibility to take advantage of, shorter term opportunities.
Right, so it's not completely rigid.
Exactly. And he clarifies that while the hybrid portfolios are designed to deliver positive returns in all kinds of markets, they tend to do especially well when riding that upward momentum of a rising market. And they also tend to outperform those traditional benchmarks when markets are going down.
Interesting, so kind of the best of both worlds.
Yeah, and he also notes that these portfolios typically have lower volatility and a moderate level of trading activity. And he uses the Dow Jones Conservative Allocation Index as a benchmark for this strategy.
Okay, that makes sense.
And then the risk management techniques used in the hybrid strategy are pretty interesting.
Yeah, like what?
Well, he talks about diversifying across those alternative investment styles and managers, and then also using those specialized short-selling funds.
Right, to hedge against potential declines.
Exactly. And then also having the flexibility to hold a good chunk of the portfolio in cash.
When opportunities are scarce or risks are high.
Exactly. Yeah, so that's the hybrid strategy.
Okay, so what about concentrated equity?
Okay, so the basic idea behind concentrated equity is that you invest in a smaller number of stocks.
Like how many are we talking?
Typically 30 or less.
Wow, that's pretty concentrated.
Yeah, and the goal is to potentially achieve higher returns over the long run.
Makes sense, but I imagine that comes with more risk, right?
Yeah, he acknowledges that investing in a smaller number of stocks does inherently come with a higher risk of volatility.
Yeah, because if one of those stocks tanks.
Yeah, your whole portfolio feels it.
Exactly.
But he actually cites a Morningstar study
Oh, interesting.
that suggests that the difference in volatility
Between those highly concentrated funds and the more diversified ones.
might not be as big as people assume.
That's interesting.
And he really stresses that managing a concentrated equity portfolio successfully,
Mm-hmm.
it's about the skill of the manager
Yeah,
over the long term.
not just picking the right stocks, but managing them well.
Exactly. And he expresses some skepticism about uh, modern portfolio theory.
MPT.
Yeah, he thinks it's too focused on diversification.
Interesting.